20 years ago, the project finance market restructured in a way that was spontaneous. It was privately driven. The banks, all of a sudden, instead of going out to lending short term, as they traditionally did, they saw an opportunity to lend long term. And they then started competing with the capital markets. This made the project finance industry very competitive, very tight. We all thought it was a great thing, but it was really a bad thing, because all it led was to excessive competition that led to excessive risk-taking. And we know the consequence of that. The problem now for banks is liquidity, it's not credit. Most infrastructure projects are very good credit-worthy assets, but there isn't enough cash. They cannot guarantee they can get the interbank lending at the rate they want it to borrow money for more than 5-7 years. So it's liquidity is the problem. So the banks are now focusing on short term. They are prepared to give letters of credit to guarantee the risk on the construction phase and allow more suitable capital markets to take the long-term view, like pension funds. Pension fund is the single highest vehicle for savings in this country. You and I, our savings, mostly are in pension funds as a country. And they have long-term views. They have long-term liabilities, like our pensions, and they are the ideal vehicle to provide long-term funding for major projects. But they're discouraged because of the RAB that I mentioned earlier on, the tax breaks that are wrong, the plethora of government organizations that are involved, and the banks' competition, which now has withered away. The banks are now refocusing their attention to mini-perms. I don't know whether you've heard what mini-perms are, but it's in a new vogue in financial industry. They are really banks lending short-term over a period of time. And the idea is there's a hard and a soft mini-perm, but I won't go into that. Essentially what the banks are doing now is lending, and if you, the borrower, do not refinance within a period of 5 years, 7 years, then they take over your asset. And they do that by increasingly making the finance more expensive from year 0 to year 5 or 7. So they encourage you to go out and refinance because they have liquidity problems. They can't guarantee the finance for more than 5 or 7 years. And that's called mini-perm. And a lot of new PFIs are now mini-permed. The capital markets, the pension funds, provide the long-term lending for construction short-term. They are the ideal vehicles. We don't use them enough. They have to be used. The government has to create the environment, as I've said before. And I'm only giving you a proceed version. This discussion could last days on all the things that need restructuring. But and what it happens, the effect is that you have unwrapped bond solution. Now, for those of you to know, there used to be most of the long-term finance used to have be insured, and there was a monoline industry that insured this kind of finance. There's only one monoline company left now, so that's all going. And this will give you the unwrapped bond solution. The multilaterals need to be involved as well, because they can give long and short-term guarantees that banks can't. That would help also the pension funds to create, through an easier transmission from savings to investment, the resources that we need. As I said, the banks are reversing into that. The beginning is started, but the election is slowing us down in terms of making the restructuring that we need to make essential for our economic recovery. In summary, investment is a priority for infrastructure. It must be, with the private sector involvement optimized to create assets. In other words, we need to further continue borrowing from the public sector off balance sheet and bring in the private sector through the mechanisms I've been talking about in terms of the RAB, the different tax structures and the pension funds. The government must improve their coordination and ease of path from savings to investment. I mentioned that earlier on. Banks are now going to focus on the short term. That is good. They should never be in the long-term game. And the capital market, through the pension and equity funds, need to take the long-term debts released from the investment requirement and the risks of the short term. So all of this will enable a sustainable resource of finance to become available with facility to invest in infrastructure projects. This one will create assets to set off against the debt that is increasing, thereby easing the economic recovery, reducing the threat of a run on the pound if we don't reduce our debt, and allowing the debt to be serviced by the government over a longer period of time without repercussions on the UK credit rating. Governments, like companies, can carry debt for a long time. As I said, it's not a problem if we have the assets. It would also assist economic growth with a higher productivity as an economy and more efficient infrastructure to help us along the way and compete more effectively in international markets. It will provide a sustainable supply of long-term finance because the pension funds are hungry. They want to invest. We just don't have the topography to allow them to do that. It will support demand as we invest in infrastructure and create new assets. And as I said at the beginning, it would help us if we're successful and take the challenge to leave a Victorian-type legacy for future generations. I would not wish to live in any other times because these are interesting. But the downside is like in the Chinese curse, may you live in interesting times. Thank you very much.